Hello, InStar trainees. Giving you a quick overview of what the economy is doing right now. Decided to make one additional video. Basically, my videos, if you notice, they don't have lots of views, is because my client base tend to be the elderly. They don't even have internet, so they don't really use a lot of this material. Why do I go with the elderly? Because they're intelligent enough to at least listen to you and make an intelligent decision when it comes to finance. Another thing that I get from people is, why don't you have like a permanent website? I did have a permanent website at the beginning. It was somewhat of a waste. Again, if your target base happens to be the elderly or people over the age of 60 who happen to have put their savings together and just have no desire whatsoever to even watch the internet, much less be a part of it, it's kind of a waste. Now, a lot of people say to me, well, you know, when you do something like that, the problem with doing that is that a lot of people like to have a website so they can go ahead and judge and see how well your business has been doing with other people. Hey, that might be true. But once again, when you're dealing with that crowd, you're talking with anybody from the age of 25 to around 58. And those are the people that want to do that. And there are also the idiots who are invested in 401ks, who don't understand the concepts of finance. And I don't feel I need a website, or we don't need a website to have them voice their ignorant opinions about finances. That's the problem. And if I don't do business with them, that's fine with me. I don't lose any sleep over it. I'm rich either way. So let's start on ahead and get on with this. We're going to do a quick video here with Rose. We love Rose. She really puts out good videos. I've thought about doing this stuff full time through YouTube, but then I say, why? Again, I like to do what I like to do, which is work with estate planning. If you wanted to see some kind of website, you can look at that one I'm a part of. It's called the Legacy Assurance Plan. You can look up that. You want to sit there and you want to look at different types of views, and you want to voice your opinion about views, because we work with estate plans that tends to be more of the elderly, and then we work with people who are, like I said, at a point in their lives that they're willing to actually listen and make some intelligent decisions about their finances. So let's get on with this.
Hey everyone, it's your girl Rose. I am back with another video. Right now the economy is at an inflection point. And the question is, are we going to be able to get inflation back down? Will we be able to do it without causing a recession? And how much more will stocks keep crashing? These are the questions on everybody's minds right now. And at the moment, all eyes are on the Fed. It's the Fed's job to keep the economy healthy and keep inflation under 2%. Obviously, they failed miserably because inflation is more in the range of, 8% these days. But the Fed's job really isn't easy. It's a very delicate balancing act to keep inflation in check, to keep it low, and to keep the economy growing at a nice pace. It's really hard to do both at the same time, because in order to control inflation, the Fed has to raise interest rates. But raising interest rates slows down the economy. It's kind of like trying to lose weight while also eating a lot of Twinkies. It's really hard to do both at the same time. So that is the big debate right now. Will the Fed be able to lose weight and continue eating a lot of Twinkies? In other words, get inflation down and keep the economy growing. Because if not, we are in big trouble. If the Fed is not able to pull this off, we're going to get something called stagflation, which is when you have high inflation and a stagnating economy. Just think higher food and gas prices, but less income and less jobs. It is a very bad combination. Now, for the record, stagflation is also terrible for the stock and bond markets. We're already freaking out over the 20-30% decline so far, but it might be nothing compared to what would be coming if we get stagflation. In the 1970s, for example, when there was stagflation, the stock market fell a total of 60% from the high before it started to turn around. And given Bitcoin's apparent correlation to stocks, if stagflation happens, it'll probably be bad for crypto too. Ditto for housing, which has also been in a bubble. So now what? I mean, basically, we are all screwed. Just kidding. We're gonna be okay, so let's all take a deep breath together. This video will help you figure out your game plan if you're either brand new to investing and want to get in now, or you're already invested and just want to make sure you have your bases covered. I'll talk about the two most likely scenarios that we'll see over the next year or two, according to experts such as Ray Dalio, Cathie Wood, and Warren Buffett, and I'll end with my best advice on how to invest right now. But before we get into that, let's start with a quick recap of everything that's happened so far. The S&P 500 is down almost 20% on the year, and the Nasdaq is down 29%. That's already pretty bad.
May 2022.
For certain
This is right now.
tech stocks. ARKK, which is Cathie Wood's innovation ETF, is down 70% from the peak. As for crypto, Bitcoin is down more than 35% year to date.
Only
Ether is
stupid
down
people
almost
invest in
6%.
crypto.
And
Is that you?
Needless to say, everybody's portfolios are getting crushed right now. As for inflation, you're probably noticing it already in your day-to-day. Food prices are almost 10% higher than a year ago. Energy prices 30% higher. And if you drive, you're now paying 1.5 times more than last year on average. So why is all this happening? Now, it's been well known for a long time that all the fiscal and monetary stimulus, as well as the supply chain disruptions from COVID, would probably cause inflation. So we were kind of expecting this. And so when the Fed started talking about higher interest rates to help curb inflation, the market reacted badly because the market doesn't like higher interest rates. This is logical because stock prices would no longer be benefiting from easy money, low interest rates, stimulus checks, and all that excess cash pouring into the stock market. I actually talked about this in my 2022 market outlook video, which you can check out right here. Now, despite stock prices suffering a bit this year, the general consensus overall was that as long as the Fed kept raising rates at a good pace, we'd probably get back on track with inflation and the economy would continue to grow and all this would just be a blip on the radar. And then Russia invaded Ukraine. I honestly can't believe the world that we are in right now. So many innocent people are dying because of some megalomaniac in Russia, and the repercussions go way beyond the borders of Russia and Ukraine actually. Because Russia produces 10% of the world's oil, and Russia and Ukraine together are basically like the world's breadbasket. Together, they export more than a quarter of the world's wheat. The countries are also key suppliers of many other important commodities like corn, barley, and even metals used to produce cars and semiconductors. So given this huge external shock factor, inflation went from being a code yellow issue to being a code red issue. Now it's no longer just an easy fix of raise rates little by little so that inflation will go away. Now the Fed is stuck between a rock and a hard place because in order to stop inflation, we need aggressively higher interest rates, like aggressive. And that could actually cause a recession, or what the media likes to call a hard landing. At the same time, not being aggressive about raising rates would mean inflation could spiral out of control. So it's really hard to control inflation and not cause a recession. Like I mentioned before, it's like trying to lose weight while also eating a lot of Twinkies. Very hard to do both. In terms of how this is going to play out over the next year or two, it all depends on how it goes with inflation. Everything hinges on inflation. In a report by Ray Dalio's people at Bridgewater, the largest hedge fund in the world, they pointed out that in the past, high inflation almost always required a recession before inflation normalized. That's unfortunate because it means that we probably won't be able to avoid a recession if inflation keeps getting worse. The report also said that the possibility of recession isn't priced into the market yet. So the blue line is where the S&P 500 is, or how it's done recently, and the red line shows where the S&P 500 would be if interest rates hadn't gone up recently. Basically, this chart is telling us that the recent stock market crash was only due to higher interest rates, the Fed raising rates, but if a recession actually hits, the stock market hasn't priced that in yet, so it has much further down to go. So let's hope that inflation goes away on its own without a recession. All right, so that is kind of the bad news, but there's also some good news. Not everyone is as pessimistic about the future. Cathie Wood, the fund manager of ARK Invest, she believes that inflation is going to go away on its own later this year, that it's temporary.
Okay, well, so much for that nonsense. That woman's insane. Not my sweet Rose, of course, here, but that woman is insane. It's not going anywhere. But, I mean, sometimes Rose will pick people that she wants to show to give you some hope when there's very little available. So, I think Rose brought up excellent points of how the stagflation works, and let's move on to the next group, which is Robert Kiyosaki.
After saving with customized car insurance from Liberty Mutual,
Yikes.
I customized everything.
We didn't want to do that.
Marco's backpack.
Oh, no.
Considering buying a car cover? Here are the most important questions to ask to make sure you get the perfect cover for
Sorry
your
about
vehicle.
that, guys.
Oh, I took your advice. I bought a house. I'm going to make some money. I said, at the top of the frickin' market? Don't listen to your stupid real estate agent who tells you that, oh, the price of real estate always goes up, because it doesn't. When I hear people coming up to me saying, oh, the price of real estate going up and they're jumping in to buy real estate right now, I don't say anything. And the reason is that people are just getting into the hype. All this credit is actually debt, credit and debt, pumping into this economy, trying to prevent this crash. And if inflation keeps going, I get richer. I am extremely.
He ain't the only one.
Biden, I'm not Republican.
We get richer
Democrat.
too here.
He intentionally wants inflation. That's why he shut down the XL pipeline. That's why he stopped drilling, to get oil prices up. When oil prices go up, you know, all these truckers in Ottawa screaming they can't get food to the table and all this. Prices of food go up. Inflation keeps going up regardless of what's going on, just because the policies of the Biden administration shutting down the XL pipeline, stopping drilling of oil, so the price of oil goes up. I watch all this, and meanwhile these people are jumping out and buying real estate like there's no tomorrow, and I can't even talk to her on a turning point. But please understand, ladies and gentlemen, inflation makes the rich extremely rich.
Yay.
The middle class will pay higher taxes, and the poor will get poor because they're the ones who can't afford the $25 Wagyu steak that my friends are selling. So that's why it's one of the biggest critical turning points, and that's why I don't know how many years ago when I walked past Rich's book and Borders, and it's the dollar crisis. If you understand what's going on, the problem is the U.S. dollar. Because in 1944, it stopped being money. It just became the reserve currency of the world. And in 71, Nixon took the dollar off the gold standard. We're being set up right now, one of the biggest changes in world history. And it's, oh, I bought a property. What do you think? I can't even talk to him. Because this, to me, is 2007 all over again, and then the repo market collapsed. 2008, the market collapsed, and back in 2008, this guy named Bernanke, I believe it was, could print money. And this is where we are today. You've got to wake up, ladies and gentlemen, because otherwise you're just this stupid little hog just driving to slaughter. So America is one of...
Stupid little hog driving to slaughter. See, I have never called people hogs before. I've called them ignorant. I've called them stupid when it comes to investing, and they earned all that. And everything that's happening to you now, you've earned this. We had our stuff out for years now trying to warn people. But I never called them hogs, though. However, I will say one thing, though. Robert's got a point here. Because people in this country, we're at 86% obesity, and pigs tend to be fat. Or at least we hope they tend to be fat. Otherwise, it's hard to send them to the market. But the point here that he's trying to make here is that, as you see on the top, the crash will be worse than 2008. Robert Kiyosaki's last warning. I don't know, you probably can't see that. Let me move it up a little bit. Now you can see it. Right there. Basically, all he's saying is simply that you're in for a fall. You're in for an ugly fall. And you asked for this. You really, truly, honestly asked for this. Because you trusted the system. Those who trust the government for their best interest and think that the government is looking out for their best interest versus the ones who think, they're in for trouble. 401ks, IRAs, all this stuff's going to crash. It normally goes every 7 to 8 years, and if you followed along with all the stuff that we do, we have told you that. It's been on the 7th to 8th year. But this is a perfect opportunity. Why wait so long? We're in 2022, and I mean, you know, the money's good now. Why wait another 5 years and do it like they normally do it? They're going to take you now. So what can you do? It's very simple. You need to somehow mentally realize you're getting screwed. Somehow. I don't know how you can do it, but somehow you've got to say, you know what? Maybe the only one that's really making anything out of this deal is the tax breaks that my company is getting, offering me this 401k and IRA. If I pull the money out now, I take the 10% hit, but back then, on the every 7th year, as I've talked many times with all my other tapes, basically, you lost 38%. But here, you're going to lose more. They're not waiting until 2008. If you watch my stuff, they're not waiting that long, or 2007. They're not going to wait. Last time it was 2017 with the crisis that Trump set up with China over the steel. This time around, hey, they're going to take full advantages of this Ukrainian war, and you're going to get crushed, and you're going to deserve it. And your hope should be stripped from you because you didn't listen. So if you do listen, that's a good thing. Because like I said, most people will see this video, they won't listen. They'll just say, well, you know, we'll come through this somehow, some kind of way. We'll muddle through. Well, best of luck with that. That's all I can say. But anyway, let's finish up this video real quick and finish up with final comments.
Can artificial intelligence make you money in 2022? Well, check out this AI bot that...
I hope it can. I know, all kind of problems today. What the fuck?
They destroy money because when they print money, they buy bonds with that money. And normally, when the bonds mature, they just roll them over and buy a similar kind of bond. But they destroy money by essentially selling those bonds. And when the Fed, what happens is the bonds mature and the Fed doesn't roll them over. Someone else has to buy the bond. So the Fed gets its money back. And when the Fed gets money back, the money just evaporates. The Fed doesn't need to keep any money because it can make all the money it wants anytime it wants to. So it's a bit complicated to explain in just a few sentences, but the bottom line is it's the opposite of quantitative easing. Quantitative tightening destroys money, and that tends to make stock prices fall. And we're about to get a heavy dose of quantitative tightening coming into effect within the next couple of months.
And it's going to make it harder and harder for mom and pop to go buy that house they're going to flip.
And isn't that going to drive inflation through the roof?
Well, they think the opposite. When they, instead of printing money, that's the thing that normally causes inflation. It stimulates the economy, it creates growth. But when they destroy the money, that tends to make asset prices fall, like stocks and property. So people are less rich, so they spend less money, and if they spend less money, then prices tend to fall. So that's why they're doing this. They're worried now that the inflation rate has moved up to 7%, and they're taking steps to bring it back down. But what they may find is this could cause a significant stock market crash. And already last month, the S&P fell almost 10%, and NASDAQ fell 15% between the 4th and the 27th last month. And some of the high-flying stocks got hit a whole lot harder than that.
Look at Meta or what Facebook, whatever else I call now, they tanked.
It lost 26% in a day, destroying $230 billion.
$230 billion of American wealth.
Your 401k, sweethearts. And that's why I spoke out against 401ks forever. You know,
Same here.
You guys are you're planning on renting your property, people won't be able to afford the rents. That's what it means.
Well, so total credit is equal to total debt, because one person's loan is another person's debt, right? So the two have to equal each other. So one way of thinking about this, the easiest way to think about it, is all the debt in the country. Government debt, household sector debt, corporate debt, financial sector debt. all the debt. It first went through $1 trillion in 1964 when I was 4 years old. Now it's $90 trillion, from 1 trillion to 90 trillion during my lifetime. And this credit explosion, which would not have been possible if we had remained on a gold system where dollars were backed by gold. But this explosion of credit has transformed the world.
Wait, Richard, hang on. You're speaking like an economist again. Credit is what the Fed and the Treasury allow people to get to the big banks, like Wells Fargo and all that, and that credit then allows people, the banks, to send out debt. So then corporations and individuals come in and they take credit and they turn it into debt, but it's the same thing. So by creating credit, debt could explode. Am I correct on that or incorrect?
No, I think you put that exactly right.
Yeah, credit's not a word people use. They use credit card, but they think about debt, their household debt. So that's what I'm saying. We don't teach economists. We teach everyday mom and pop who's trying to speculate on their 401k or their house.
The reason I tend to use credit is because I say this system that we have now is not capitalism, it's creditism.
Yes.
Creditism sounds better than debtism. I tried that. Creditism works better. Capitalism to creditism. Because credit growth drives economic growth now. We're dependent on it.
Yeah, what Richard is saying is the way America grew was because we produced products. Now we don't produce products, they create credit or debt. Am I correct on that one?
That's right. Instead of our economy being driven by investment and savings as it used to be, it's now driven by credit creation and consumption, and more credit creation and consumption. And that's been great. The problem is it requires credit growth to survive. If credit contracts, we have a depression. And that has made us dependent now on government borrowing and government spending to keep us out of depression.
So if you're going to buy, I don't know how many people, I took your advice, I bought a house, I'm going to make some money. I said, at the top of the frickin' market? And what about all these guys in these 401ks? 401ks came into existence in 1974. It was called ERISA. And I've been speaking out against 401ks.
You ain't the only one.
I'll get censored with this one. But 401ks are like a condom. It gives you a false sense of security while you're being screwed. Do you know what I mean? And if this market crashes, when they raise these interest rates, if they do, your 401k turns to 201k. Just as you get ready to retire, all you old guys like me, hear what I'm saying? If they raise interest rates because they're going to stop inflation, your 401k may be toast. I'm not saying it's going to happen, or if you're a millennial and you got mom and dad who are living in La La Land with their two 401ks.
My name is Ross Hamilton. I started.
Okay. Pretty interesting stuff. Let's finish this up. I think you're catching the drifts here. And the drift is very, very simple. You need to change your habits. You need to realize that sticking with the U.S. and the investments that you've been trained to use is going to get you broke. It's going to keep you working for the rest of your life till you're dead. The choice is yours. Okay? With us at InStar Alliance, granted, we don't have a website set up for you so that you can make your worthless comments about how well we did or didn't do. But the bottom line is, we're out there anyway. And like I said before, most of our people that we work with tend to be, around retirement age. They don't even bother with the internet. I'm telling you. I've done these seminars on estate planning as well as investments and alternative investments overseas. And I'm telling you, I talk to them, well, go online and check this out and check that out. And it's like deer in the headlights, man. So it's up to you what you want to do with your life. And we wish you well. However, you're in the D.C. area, you know how to reach us. Simple as that. We forgive and forget whatever you've done in the past, what other stupid mistakes you've done financially. You have to break your core training. And you have to cut that financial advisor loose. You need to get out from under those 401ks, IRAs. You need to put that money in something that's secure so it doesn't fall out from underneath you. Unless you like quicksand. Choice is yours. Good evening.